In 1994, the hedge fund world had its eyes on a promising new fund called Long-Term Capital Management, LTCM. Their star-studded roster was packed with financial industry heavy hitters of the modern portfolio theory, MPT, and efficient market inclination. It was an opportunity to, on a global stage, prove the validity of the underpinnings of the stock and bond only buy and hold strategy. Yet, when it ultimately failed miserably, pundits and experts continued to sell the same easy narrative as they always have to the investing public. Welcome back, you beautiful 17,000 subscribers. Disclaimer, this is an unpopular opinion, but it's something I've dedicated years of my career to understanding. Because if I'm right on this, investors should know. You should know. The people we care about should know. So I hope you'll hear me out over these next few videos and let me know in the comments what you think as we go. Open and honest discourse. That's how we can all best learn together. All right, back to the story. LTCM was founded by Wall Street heavyweight John Meriwether, the former vice chairman and head of bond trading at Salomon Brothers. He's a big deal.
Thank you very much.
With his influence, he was able to attract the best traders in the industry and beyond. His pull stretched into academia, where he even attracted the likes of 2 Nobel laureates. Anyone who has ever traded or studied stock options is familiar with the Black-Scholes model for pricing these popular derivatives. Investopedia defines this model as follows. The Black-Scholes model, known as the Black-Scholes-Merton (BSM) model, is a mathematical model for pricing an options contract. In particular, the model estimates the variation over time of financial instruments. It assumes these instruments, such as stocks or futures, will have a log normal distribution of prices. Using this assumption and factoring in other important variables, the equation derives the price of a call option. Myron Scholes and Robert C. Merton, 2 of the academics behind this esteemed model, signed on with Meriwether. The models they built for LTCM were rooted in the idea of efficient markets and a log normal distribution of prices. In other words, they were using past data to make sure bets about what would happen in the future. That's the same founding principle behind modern portfolio theory and the stock and bond buy and hold strategy touted by so many experts today. Put simply, this is what LTCM was doing. Their models, definitively proven by historical data and backward-looking analyses, would identify arbitrage opportunities in the market. Then LTCM's expert trading team would go to work, leveraging their immense portfolio to the extreme in order to squeeze every last dollar out of each and every opportunity. All right, the stage is set. It's time to put these historically based academic theories to the test. That is, these theories that are reliant upon the same data set and logic as is that cliched buy and hold strategy, to definitively draw our conclusions as to whether or not we can absolutely rely on this historical data to draw our forward-looking conclusions, as they were doing here, and as a buy and hold advocate would be, well, advocating. To the LTCM partners and to the many high-profile banks and investors who fell all over each other to get a piece of the pie, their strategy was foolproof. With the salesmanship of Merton, Meriwether, and Scholes, by the time they launched in February 1994, the fund had amassed more than $1 billion in startup capital, an unprecedented feat for a brand new hedge fund. The firm was wildly successful at first, generating returns of 28% in 1994, 59% in 95, and 57% in 96. In 1997, LTCM still managed to realize another 25%, despite controlling more than $100 billion in assets. In his brilliant book, When Genius Fails, Roger Lowenstein observed, Merton's theories were seductive not because they were mostly wrong, but because they were so nearly often right. As the English essayist G.K. Chesterton wrote, life is a trap for logicians because it is almost reasonable, but not quite. It is usually sensible, but occasionally otherwise. It looks just a little more mathematical and regular than it is. Its exactitude is obvious, but its inexactitude is hidden. Its wildness lies in wait. To most, it seemed as though they had cracked the code, There were a few reputable names in finance, however, who expressed concern with LTCM's overconfident reliance on past data. Most notably, Paul Samuelson, the first economist to win a Nobel Prize and Merton's MIT mentor, had his doubts from day one. The essence of the Black-Scholes formula, Samuelson observed, is that you know with certainty not what the deal of the cards will be, but what kind of universe is being sampled. This is important. We'll come back to it in a later video as well. Lowenstein elaborates, the beauty of cards, to reference this example, is that the universe is known. There are 52 cards in a deck, and only 52. Life insurance is a bit different. Since new people are always being added to the universe, actuaries rely on samplings. They aren't perfect, but they work. Because the sample of people is very large, and mortality rates change only very slowly. But in markets, we are never sure that the sample is complete. The universe of all trades looked one way throughout the 1920s, and another way after the Great Depression. The pattern changed again during the inflationary 1970s, yet again in the effervescent 1990s. After which of these periods was the picture normal? And how do we know that the next new period won't change the story again? We will never have a complete data set when it comes to stocks and markets and economies. One thing we can be sure of, however, is that the story for each new period will, in some likely unanticipated way, be different. At the end of 1997, the story did indeed change. Long-term capital management was highly exposed to a, ready? One-of-a-kind financial crisis in Asia. This was an event for which Merton's and Scholes' historically based models had not prepared, but the fund survived. That is, until the following year when yet another one-of-a-kind financial crisis wreaked havoc in Russia. The Russian government defaulted on its domestic local currency bonds, a decision very few thought possible, especially those at LTCM with their backward-looking data. By the end of August 1998, the fund had lost more than $1.85 billion worth of capital. Lowenstein offers this perspective. Theoretically, the odds against a loss such as August's had been prohibitive. Such a debacle was, according to the mathematicians, an event so freakish as to be unlikely to occur even once over the entire life of the universe, and even over numerous repetitions of the universe. But it had happened to long-term, not quite 4 years, after Merriweather had written to the firm's investors, confidently endorsing Merton and Scholes' so finely tuned assumptions. According to their mathematical models, the financial fluctuations that resulted from these rare events were, for all intents and purposes, impossible. Yet the historically based impossible seemed to keep happening to them. In the first 3 weeks of September, long-term's actual equity crashed from $2.3 billion to only $400 million. The fund effectively lost 92% in 1998 before, under pressure from the Federal Reserve, a consortium of Wall Street banks reluctantly bailed them out. So it would have been even more. Long-term capital management put modern portfolio theory's backward-looking logic to the test. It's the same logic being used to promote the buy and hold strategy. Because it's worked in the past, it's obviously going to work forever into the future. LTCM's remarkable failure took place on the world stage. Yet here we are. Advisors, pundits, and academics still trying to use historical data to predict forever into the future in order to tell you what to do, how to invest your money. We're just getting started exploring these issues together. I wrote an entire book on the subject after all. I explore the logical fallacy behind buy and hold in even more entertaining detail in this video. And if it's not there yet, I'm still editing it, so you should probably subscribe and make sure notifications are on. And in the meantime, you could check out this video, which elaborates on a few potential suggestions for better ways to invest. Don't forget to say hey in the comments. I really do enjoy getting to know you guys. I want to help. Take care.